Okay.
Great. Thank you very much, Sean. Thank you very much, everyone. Welcome to another session of RMS Smart Investing. It's our class about different subjects, and I thought today it will be timely maybe discuss something about options Greeks, go deep. Today the subject will be more on delta. We go a little deeper in the meaning of delta and also how we can use that in hedging our portfolio. We're gonna actually from the hedging, we're gonna touch the tip of the iceberg, but I just want to open the door for the future that when we want to speak more about portfolio management, asset allocation, and of course, hedging plays a big role. So I'm opening the door for that, but it will be informative to at least get a little understanding and how the delta can help us in order to achieve our goals and minimize our risks. So with that in mind, let's dive in and review. We've had a class on options Greek, so I'm just going to briefly just have a little review because I think it's very important to understand what are the meanings of these Greeks because they affect basically any type of movements that options have, and especially with all the strategies that we use. We just not a directional, we just don't go buy calls and put. We have studied different strategies in the past, and by understanding these Greeks, you can actually make your trades more profitable. So briefly, like, let's just talk about, there are 5 of them. We emphasize more on the on the 3, but there's 5 of them. The 5th one, the row, which is the change of the option price and the stock prices move based on the interest rates. And as you know, the interest rates have been so low, they don't really play as much of a role. So the big one is the delta, and we will again today we're gonna concentrate on that and explain how the delta affects your positions and your pricing of options. So basically what delta is, again, we call it the rate of change, the measure of the change of option price when the stock moves $1. So that's really the relationship between the stock and delta, which is really the first derivative, or it's like the first effect of the movement of the stock on the options. Then you have gamma, and gamma basically is considered second derivative, and basically what gamma does is based on delta. So what it does, it says based on the movement of the stock price, how much of that movement affects the delta. And we can use some examples. Let's say if it's like 0.02, if the stock goes up $1, the gamma being 0.02, the delta will go up accordingly 0.02. So as these prices are going to our direction and getting more in the money, the delta actually improves. So again, gamma depends on the price of the stock and the delta, so it's a derivative of delta. Vega, as it starts with a V, is basically measurement of the volatility, the implied volatility, which plays a huge role as far as the pricing of our strategies and option choices. So, and that's one of the reasons we really like options, because they are not just purely price dependent. Because of these Greeks, you can set a portfolio of different options strategies, which could be really price neutral and directionally neutral. And that's what it's important again to understand that. So Vega says for every movement of the volatility, what happens to the price of the option. So, and basically the volatility, when you look at it, it's not the percentage, it's also points. So let's say implied volatility was at 30 and it goes to 33%. From 30%, that's 3 points. So when we look at the Vega, if it goes up 3, how much of that affects the option price? Now the theta, we have worked with this a lot, which is a time decay. And it's important again to understand the theta, especially we work a lot with the credits, and in credits really we are very much theta dependent. We like it to decay so we can keep our premium. So theta is obviously is very important, but we've discussed it in the past. And rho, as I mentioned, it's not as significant now as it has been in the past. So I just want to show a little different ways, again, with the delta, it's more explanation how they work. So today I will have a lot of our slides are more of a reference. So you can, if three of them you want to print them out or save them, it's more of again, the reference. If you're doing some trades, you can just look back and say, well, you know, what was Vega again? How did it affect? And that's what it is. Again, today I'm going to emphasize more on the delta. Now, before we go further in that, so this is another one of our cheat sheets. So to see how the delta, theta, vega, and gamma help us basically to set up our strategies and see how they will help us in achieving, again, profitable trades. So let's start with delta. As we mentioned, the delta is the change of the option price uh, based on the change in the underlying asset. Let's say if it's a stock. So if option price is going up 50 cents and change of underlying asset, you always use $1, then our delta is 0.5. So it's 50%. So how do we use delta to our benefit? Basically, delta being positive if you are a call buyer, or the opposite, the put seller. So as delta improves, it's good for our call because the premiums go up. Or if you're selling the put, we are hoping it's going to go up, then going to keep the premium. So delta also is positive. Now the negative is obviously it's the opposite. Instead of put seller, you become put buyer, and instead of call buyer, you become call seller. So basically, you will see that they usually are opposites. Now the theta, again, the change of the option price based on time. So as the time is getting shorter and shorter, we have a more and more decay and reduction in theta, which is absolute numbers. When you see the thetas, if it says minus 20, that means, as time goes, every day goes by, we lose 20 cents, for instance. Now, what is positive, and that's what we take advantage of it, is when we are the seller of an option, because we remember when we selling something, we don't want it to get there. And by not getting there, that's when we keep our premium, and the time help us. Sooner it gets there, that the point that, the side the time goes by and we are not there, it is to our benefit. So that's why the theta is positive when we are a seller, but negative when we are option buyers. And when you're a buyer, although the price might not move, maybe implied volatility didn't move, but every day you notice that the price of your option is going down, especially as we get closer and closer to the expiration. That's the theta effect. Now, the vega, as we mentioned, is the volatility from a V. So the option price is changed in 1% of the volatility. So as I mentioned, if the volatility goes from 30 to 31, that's how much the option price will go. If it's positive, it will go up. If it's negative, it will go down. So if I'm the buyer of an option and volatility goes up, then that's positive for me. So we like the positive gamma. But if you are the seller of that option, obviously it goes against us, because then at that time, as the price is going up, we are not holding it, keeping as much of the money as we were hoping for. Now, as far as the gamma, as I mentioned, it is a second derivative. So it's a change in delta based on changing the $1 of underlying assets. And again, gamma is good when you are a buyer in an option, but it's negative if you're the seller of option, because gamma helps delta. Delta goes up. If you recall, we were as a buyer, it helps to become more profitable. So this is a little maybe advanced, but because we're going to talk a little about the portfolio, I thought let's do a little cheat sheet. Let's say you have a portfolio, which we will talk about as how the delta is going to help us. Let's say one of the things I'm going to emphasize today is one of the mistakes we make as an option players and traders is we look at things on an independent and singular trade. So if you buy a call option, you hold on to it, and then you have you have a vertical. You talk about, okay, how am I going to get out of this? You want to look at this as a whole portfolio, and that's what we're going to talk about. How we can look at the delta of your whole portfolio, which is very much dependent on the direction of the market, rather than look at things individually. So because of that, let's say you have a portfolio and you're looking at studying and you see that, oh, I have a long Vega and I'm looking at my portfolio. I see a lot of things are the short delta. So what happens is when the markets go down, that's very profitable for us with that. And in a bearish environment, so because we think it's bearish, that's why we want to use the short delta and long Vega. If the environment we are bullish, then we go complete opposite. We want to have a long delta. We want to buy that delta, and we want to have the short Vega. Now, when the stories are not in harmony, what I mean is like your delta is short and your Vega is short, then there's contradiction. That's a neutral portfolio, and then or the opposite, long delta, long Vega. Now, this is a little, again, advanced. I just want to open the door. We will discuss this in the future, but I just want to, as I mentioned, I want to use these as a more of a cheat sheets for your own portfolio in the futures. If you're looking at, hey, I have this portfolio, should I go, if I want to neutralize it, should I go short delta, should I go long the delta? So, and basically let's open the door. So let's talk about delta. All we know, there's a couple of things we've talked about the past, and most people just work on two main things about delta. The first one is the rate of change, which is the definition was, and the probability. But I'm going to go deeper. I want to understand how delta actually can help us to build a portfolio based on understanding the meaning of this. So we're going to discuss the rate of change, as I mentioned, the probability, but what it means as a shares of stock. How about within the money, at the money, out of the money, how the delta behaves? What about the directional bias? How about at expiration, soft versus hard? How about the time affecting your delta? How about if you have trade strategies, how your delta behave? If you have, we play iron condors, we have verticals, we have direction, we sell a call. How does that delta is being affected with those strategies? And the last but not least, which as I mentioned in the future, I'd like to emphasize more, is the hedging style. How we can use delta to hedge a long-term portfolio, for instance, that we have. Let's say we have a portfolio that we want to have it for the next 5 or 10 years, or we have it for 1 year, or even maybe for a swing trade for the next few weeks. Can we use delta to hedge our portfolio? So with that in mind, let's dive in and start with the first one, which is the most accepted definition. This delta is the rate of change of an option for every dollar move in underlying assets. So as you can see, the delta cannot go, it's like 1-to-1. So you cannot have 125% movement. So if the stock moves 1, the most that delta will move is 1. So it ranges from -1, which is for the put side, to the positive one, which is the call side, which is if the call is 0-to-1, or the put is 0 to -1, because if the direction is going up, remember the put is going opposite. That's why you have the negative. So the delta range, so right off bat, it's going to be between -1 and 1. The probability, we've also looked at it and we say, okay, if the delta is, let's say, 0.5, we use that as a rough idea. It's not precise, and most of your option pains, they do have in the money probabilities. So you have the IM or OM out of money probabilities and in the money probabilities. So it is there. Those are a little more precise than delta, but delta comes pretty darn close to those probabilities. So basically, if a delta is 0.5, that means there's a 50% chance that your option will be in the money at the expiration by 1 penny. So what happens is, again, you have an option today, Friday is the expiration. If your delta is 80, there's a good chance, close to 80%, and you'll see that in the money probably is like maybe 79.8 or like 81. There's a good chance that you're gonna be in the money by Friday's expiration. So that's what the delta right off bat can tell you, is the probability of being in the money. So that's the second thing. And these are the two that a lot of people are familiar with. So let's go a little deeper and understand what else can be used for deltas as far as giving us more information. So as you recall, one contract of option is equal to 100 shares. So when you exercise it, if you had one contract, you will either deliver or receive 100 shares of stock. If it's two contracts, it'll be 200. Now, if your delta is a decimal point, so which let's say it's a 0.6, what all that means is or 0.5 in this example, let's say it's 0.5, all that means is that one contract based on delta will control 50 shares. If the delta is 0.9, it will control 90 shares. So the movement of so basically it tells you how the movement of the shares will translates to delta. So that's another way of translating how many shares you will need, for instance, to have, let's say, 100. So that means you will need two contracts at delta 0.5, for instance. So that's a third understanding of delta. Now, what happens if with delta, as far as the direction, as far as being in the money, at the money, and out of the money? So in the money options, they do have a high delta, because that means a higher probability that by the time of expirations, they're going to be in the money. So when deep in the money, when you go really deep, then they are very close to 1. That almost like holding a stock. So that's 1 to 1. When you go at the money, it's usually near 50. And why is that? Why the at the money is usually around 50? Because that's the most confusing time, because it's right at the money, right at the price, which is today's money, let's say the stock price, and the chances of going up or down is 50-50. And that's why it's like the most really unpredictable time is for the at the money options, and that's why they're 50-50. In the money, there's like, so especially deep in the money, it's a lot more predictable. Out of the money is also predictable in the sense that the chances are very low, and that's why the delta is pretty low. So as far as out of money options, we have a very low delta, and we will see a couple of examples about that. Now, the directional bias is, we talked about the calls, they do have 0 to 1, so they have a positive delta. And the puts, they have negative delta, because we mentioned again, when the price goes up, as you know, the put is putting down, so we are betting it's going to actually go down when we put something. So when the price goes up the opposite way, the puts actually lose their value, they go down. That's why they have a negative delta. Now, if I have a call, when I sell a call, then I will have the opposite of buying a call, so that would be negative delta. When I sell a put, on the other hand, again, we negate the negative side, so we have a positive delta. So basically, this is important, so you know if you're selling put, then you will look for positive delta. Now, also the delta will reflect your portfolio's overall bias. And what I mean by that is, and that's why it said, you want to look at, let's say you own a call. Remember, the calls have what? Let's say you have 100 calls. They have positive delta, right? So you say, okay, I have this 100, and remember, each call is 100 shares, so that's like 10,000. So that's 10,000 plus delta. And let's say the delta was 1, let's say it's in the money. Then you have stocks, and then you also have sold some puts. And remember, when we're selling some puts, that's also positive delta. So right now, everything that you can see, everything is positive. You own stocks in technology. That's a positive delta. So when you put everything together, let's say in my example, let's say you have a portfolio which has all positive deltas. What that means is your direction is biased towards going up or bullish. So what that means is for every dollar that it's the market goes up, you make 400 in a sense because your delta, depending on your delta. So basically that means that you have um, completely positive. So what you want to do, let's say in the meantime, you actually have some puts. So let's say you had two put options on SPY. Just use that. So that's negative, and the delta is zero 0.7. So that's negative 140. So because that delta is negative, then you add it to this 400, then your net will be 260, for instance. So what that means, that's why it's important to have some negative delta that like the day like today. Imagine if you had a negative delta today, you would have made a lot of money because the market actually was going down, and what was happening, your negative delta was making money while your positive deltas, they were losing money. I hope that makes sense. I mean, we will discuss this more in the future, but I just want to get an understanding of, you don't want to look at, when you look at your portfolio, you don't want to look at them on a individual basis, very excluded from the others. You want to look at this totality. The other thing is at expiration, your delta is going to be either 0 or 1. And what that means is if you're in the money by 1 penny, that means that the options will turn to stock, correct? So if it is you bought a call, you sold a put, you basically, when you bought a call, if you're in the money by 1 penny, then your delta automatically becomes 1 because it turns to stock. If you're out by 1 penny and it expires worthless, it expires, that's 0, which is worthless. So at expiration, whenever it is, it's going to be either 1 or 0. There's nothing in between. And this is, the Friday, for instance, the majority of, let's say, weekly options or monthly options. Now, there's also something called soft and hard delta. And what does that mean is delta on options are considered as soft because it changes, and we've seen it with time. It will change with price. It changes with volatility if even there's dividends or even interference of the interest rates, which is not as effective now. So they can fluctuate. And basically, because of that, what happens is it's actually good for you in a sense that you can manage the risk of your portfolio, but also the direction and the amount of investments at risk. So these are called soft. Stocks, they always have a, just a one hard value, and that's 1. So the stock either goes up or goes down. So it has that directional. So they call them hard delta. The futures also do. Futures, although they have expiration, they roll, but we can roll them, but they don't have the time value. They don't have the volatility premium. All they do, they are really directional as well. So basically, because of that, the delta on stocks and futures are considered hard, while delta on options are considered soft. And as I mentioned, it's actually to your benefit in some ways that it is soft and it can fluctuate. One of the things I also have to mention, we talked about expiration. Delta gets pretty erratic as we get very close to the expiration. So delta can go up and down as we are very close, which we shall see. I will use an example. So, and that's what the changing in time. So delta changes with time. We talk about the prices, and in this case, when there's less time, then it will be less. Um, it will be less delta. As we get closer to the expiration, the delta goes down because the probability of reaching that goal is getting lower and lower if we are, out of, that probability. But also, uh, again, I will use an example. For instance, here, with the time to expiration, let's say the stock is at $60. As we are, the farther we are, and the more in the money we are. So we mentioned in the money, we are very much um, are very close to one. We are out of the money, we're very close to zero. But also the time-wise, you can see with 9 months, as we are farther from the time of the expiration, the higher the delta. As we get closer to the expiration, the delta keeps going down. So in all of them, you can see with the 3 months, for instance, this is a 3-month option. We were way in the money. Let's say in this situation, we were at $40 and the stock is at 60. As we get closer, then the delta goes down. As I mentioned, the only time is when it gets very close to the expiration. Sometimes delta moves up and down. But other than that, it is it is it's important to know that as the farther we are from the expiration, and the more in the money we are, the higher the delta. So I want to use this example. For instance, this is on United Airlines, right? So let's say we look at the June expiration. So this is our delta for the call side. These are our strike prices. This is the delta on the put side. You can see this gray shaded area is in the money. We are right around here is at the money, and then these are out of the money. Same thing, the opposite. The shaded is in the money, and this is out of the money. So let's just look at the calls. So you can see for June 18, when like a $38 call is acts like almost like a stock. It's 1-to-1. So what that means is if the UAL moves up $1, basically this option, which you can purchase it around 17 and 65 or so, or 18, let's say, that will go up $1. Now, as we go lower and in the actually getting closer at the money, you can see we are right around in the 50s. And then as we go out of the money, it eventually gets to zero actually, so 0.01. The opposite is true with the UL options. Again, today was a little volatile day actually. Today it was like some of these were changing to one and then going down again. And but you can see we're very close to one as we are in the money in the put side, and we get to close to zero as we are out of the money. So that's how delta acts. So delta at the money is usually around 50 on the both sides. In the money is close to one, close to one. Out of the money is close to zero or gets lower. So that's one example. The other thing is, let's say, again, with the UAL, we have option expiration, we have May 21st, which is this Friday, and then we have next Friday. As you can see, again, the close to the at the money, we are, a couple of 2 or 3 points lower than the future. So as I mentioned, as we get closer to the expiration, things start really moving a little erratically, which is in 2 days. But that's what happens. As the time goes up, your delta goes up. Okay, so another maybe like a cheat sheet you could use is what happens to your delta if you have different strategies with your portfolio and you have like few accounts and you want to see how your delta gets affected. So let's say we talk about, remember, if we buy a call that's positive delta. Now, if you're selling a naked out of the money call, that's negative delta. So what that means is we are uh, basically thinking the market's going to go down. That's to our benefit. So that's when you want the markets actually go down. So you have a negative delta. If you sell out of the money put, on the other hand, you're betting the market's going to go up. So that's positive delta. Now, selling out of the money called vertical spreads, that has a negative delta. Selling out of the money put vertical spreads has a positive delta. If you have iron condor, you don't know which way it's going to go. You think it's going to stay within a zone, then that's a neutral delta. If you have out of money called calendar spreads, that's positive delta. Out of the money put calendar spreads, that's negative delta. Now, I'm throwing a lot at you, and I hope you will have some time to just digest this. The reason I want to show you this is, let's assume you have a mishmash of different strategies. You have your weekly play, you have swing trade, all of those. I just want to give you again the cheat sheet, so just by looking at it, and let's say you have, okay, one out of the money call, well, that's negative, and then I have another call vertical spread I've sold, that's also negative. So by just looking at that, you can say, my portfolio is maybe too negative. Maybe I have a lot betting that I'm biased toward too much negativity. Maybe I want to hedge myself, maybe kind of reduce my exposure, because everything I see is like they're a negative delta. So maybe I should buy something which is positive delta, go long, maybe buy shares. And that's the whole purpose of this, again, this class, to make sure that you can control your risk. Continuing, now that's the big thing that I've found out about delta is the hedging capability, and that's what delta helps us to do. So let's say you have a portfolio and you notice that you have exposure, and let's say you have put options on um, quite a bit of exposure to the negative delta. So what you could do, you could actually hedge your portfolio. As I mentioned, you could buy some shares of stocks in the market, let's say SPDR IWM ETFs or larger cap stocks, or you can use the futures as a hedge. Now, this is the futures we talked about last week, is important not only for obviously we think about the speculators, about making quick day trading money, but majority of a lot of futures is effective as a intermediate hedge, and a lot of hedge fund managers and portfolio managers use the delta to hedge their exposure to the markets. And futures are actually the most liquid way and the fastest way to actually protect themselves from the movements of the market, especially if they are long the market, they want to short it. That's what they use selling futures, by using the hedge ratio we call. Or if they are short the market, maybe they want to go long if they think the markets will be pretty volatile for next month or so, they use the futures. So there's a couple of ways of doing. Now, what you want to do, I mentioned, you want to make sure you find the right delta for any strategy that using, the products that using to meet your objectives. So finding the delta, if you recall some of the strategies that we use, I'll give you one example. For instance, we did diagonals, right? So the diagonal, what we suggest is, well, let's buy um, 0.5 delta, even maybe more, but sell maybe 0.3 or 0.25 or 0.35 more, which is less of probability delta. So that's a strategy. So this is you're using delta as your guidance. When we do poor man's covered calls, for instance, when we go use leaps, we go long term, we want to have like a delta 0.85. We want to make sure it's as close to a stock as possible, except we don't have the funds to do it. So basically, by using that, then we can actually start selling against it. So basically, that's why it's important to know what the delta is. And then also, I mentioned about looking at those deltas in your portfolio. If you see your really bias is one way or another, that creates risk. So this, by knowing that, then maybe you should close some of those positions that you have. And make sure that uh, when you validate your hedge, let's say you did have a hedge, don't let that hedge become a source of risk and it like overtakes your initial buys. Those are supposed to be temporary things. So if they're not working, you want to get rid of it. So um, we've done in and out of spreads in the past, and those are good things. And they are we can use it as a day trading. We can do for weekly options, and they are more of a theta neutral, and they can be helpful again in neutralizing your positions. Now, put calendar spreads can be used to create negative delta and a positive volatility exposure. So we can use it. We've talked about the calendar spreads, and what we could do, we can actually create that delta and basically remember when we talk about calendar spreads, we want to buy the lower implied volatility and sell the higher implied volatility to take advantage of the movements. So if there's implied volatility expansion, you want that the lower volatility move more. If it's or if this goes the other way, you want to make sure that you collect basically the short side sooner. So basically, that's why it's important to evaluate again how you can hedge that. So in a nutshell, it's just a little graph. What we look at what hedging is. Basically, we talked about delta is the change in your options, which is delta C divided change in your stock. So basically, it's the slope. So basically, again, if the option moves 70 cents for every dollar stock moves, then the delta is 70.7. Or the opposite will be if you know your delta and you know your stock, then you can find how much the option will move. And basically, again, this is one example. I have a couple more examples. So if your delta is 0.7, or for every dollar that stock moves, then your call option will move 0.7. And the delta hedging that I will use an example for you is that's what we use. If you know the delta of your position, then you can use it to hedge your total portfolio. So for instance, let's say you own 3,000 shares of XYZ, and that's bias is you're bullish, you think it's going to go up, but you've had like the days like today, you get a little nervous, but you do have long-term capital gains on this, and you feel long-term this is a good position to be in, so you don't want to sell your positions for whatever reason it is. So you want to insure yourself, and that's why you want to buy, let's say, a put option, for instance. So you go and choose accordingly. You look at the things and you find that delta 0.6 for that option is the most attractive one. Let's say it's like 3 months from now. You want to insure it for 3 months. So basically, how many options do you have to buy? Is remember every option is 100 contracts. So basically, if you have 3,000, you divide that 0.6 times 100 because for again for every one contract there's 100 shares. So which that means you have to go purchase 50 put contracts for that XYZ expiring in 3 months to protect yourself for next 3 months. This is a wasting asset in the meantime, as you know, the premium. So you're paying, it's almost like the insurance premium, right? But if you want a dollar for dollar, you want to make sure it completely they're going to be completely neutral, except the cost of the premium that you pay, then that's how you would know that you will need 50 put contracts. You're not going to go randomly and say, oh, I have 3,000 share, I'm going to go buy 30 contracts. So this is how you would know. Or let's say the opposite. You actually own the options and your bias is, again, you're positive. You own 20 call options on XYZ. And, but again, you're a little nervous, but you don't want to get out of your calls. You think for next week or so, things going to be jittery, but eventually it's going to come back. And the interesting thing is like that's what we've had like last 6 weeks, right? So 6 weeks, the markets really haven't they've done this big EKG kind of things, the heartbeat, but they've been steady. So let's say you do have the call option, you're positive, but you think for the short term you want to at least make sure nothing serious is happening. So basically what you could do, you can look at the delta of this call and it's 0.5. And what you will do in order, again, just for short term, you will find out that, okay, if this is zero point 0.5 and I need 100 shares, so basically delta of 0.5 that's we mentioned about, that represents 50 shares. And because you have 20 contracts, 20 times 50 shares is 1,000 shares. So that means you will short 1,000 shares to protect your call option just in case things are going down. This is just a simple, again, it's just I want to get the concept. This is it's much more can be more complicated, but that's the idea if you wanted to hedge yourself. Um, Last but not least, I want to talk about, it's very important about the diversification. Now, we have talked about portfolio management. As I mentioned, I'd like to do one class on the portfolio management because, majority of our assets are not in a short term. They're not for our trading account. Now, trading and the classes that we are doing right now, they are more of an income generation. So they produce income. Most of the wealth is done on a long term, and that's our investment accounts. It could be in our retirement accounts, or it could be our general accounts that we have. And our outlook is maybe 5, 10, 20 years. So when we talk about portfolio management, we look at the diversification, the asset allocation. The interesting thing is when we're talking about, as far as our option strategies, not many people talk about actually looking at a portfolio of things. You look at things again, as I mentioned before, there's like a single strategy. Okay, I have this, I'm going to go in. It's important to have a diversified strategies. So when you are having options, just don't go directional. Have different ideas for different environments and basically set your mind knowing that what is your purpose of being involved in this, again, this portfolio. So you want to, first of all, it's everything we've talked about in past year or so I've been saying, it's about your risk management. You want to make sure you spread your risk. One of the things you want to do, you want to have multiple expirations. So just don't do, I know a lot of, we do the weekly options, and that's more of, again, income producing. We do have our day trading, the gap play, for instance. But you want to have, if you are biased about something, and let's say you want to go all in, you think you're positive based on, linear regression or a squeeze play, or you look at the Bollinger Bands or Ichimoku, and you think, for next 3 months, this is a good value right now. So rather than going and buying, let's say 1 month or 2 month options on them, it's better to have like 3 different expirations. So maybe you can do a 2 weeks and do a 6 weeks, or and then do a 3 months. So this way your if you were going to do 10 contracts, maybe you can do 334 or something like that. So that's very important. And also you can do multiple strikes. So if you're doing verticals, maybe you can do 3 different verticals in a sense. And depending again, your objective. So if you're doing the weekly, granted, I can see that, but that will be one. But if you're doing more of a longer term, then maybe you want to do it multiple strikes. And if you're doing diagonals or calendars, even iron condors, so you can have different kinds. If you were going to buy 10 iron condors, why don't you again do maybe 3, 3, 4, or do 3, 5, 2, something you want to diversify. The last thing I would say about today's class is not only the diversification is important, but also you want to know the objective of your portfolio. I've been asked before, what do you do if you have, you have a capital? That capital allocation is the most important thing. I think we talk about risk management, we talk about diversification, but allocating that capital and managing that risk based on that capital, which we've talked about 1% rule, 2% rule, is very important. So, for instance, I said I have multiple portfolios. and each one serves a purpose. So if I have a day trading, that's my specific allocation for that day trading, and that's what I use my capital for that. So I don't mix it. But majority of the money is usually either in like a longer term, like a retirement account, or maybe you can use it for intermediate, I call it swing account. And that's where usually it's a good amount, 20, 30% of your investments are. And that's where you want to do week to 3 months. So that's where you can focus and use the diversification. Now, the day trading, I can understand. That's your income producing. And as I mentioned, eventually we can mix the options and hopefully we will get to the place that we can do futures. And that will be your day trading. It could be from minutes to hours. You can do the gap play or the first hour play, use Fibonacci, but the swing trade will be the one that will make you the most money. But the majority of our money, most of the time, is in retirement accounts. So you want to look at something longer term, and that's one you have to manage it based on that. And that's why, like, just use one example. That those are good accounts, for instance, to use covered calls, especially in your retirement accounts, and make your strategies accordingly. So even if you are playing, as far as like calendar or diagonals, you can play it accordingly. You can go longer term. You can go 180 days. You can go 120 days because this is a longer term account. Basically, you can use that, but allocate your capital accordingly. Don't mix everything. Don't put everything in one account and say, I have a mental uh, as far as accounting, I know, okay, out of this 100,000, 10,000 is my day trading, 30,000 is my investment, 60,000 long term. It's better to have basically separate account. I can understand, there might be the pattern day trading rules that you want to make sure you have enough money to be able to do a lot of trading, but at least majority of your money, make sure it is allocated the correct way. So with that in mind, I'll hoping it was informative. Again, it was my purpose was just to show you, delta, for instance, is just more than just zero point 0.5 telling us the movement, and as far as just the probability, there's a lot you can do with delta. We've talked about theta. Maybe in the future we will talk about vega and gamma, how we can actually use the strategies for volatility and also the gamma plays on the long and short. So with that in mind, I appreciate your attention. I hope it was informative. And Sean, we can open up for Q&A if anyone has any questions.